retirement planning strategies that still work when Social Security benefits reduce. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. Imagine for a moment that you are 10 years into your retirement. You've settled into a comfortable rhythm of travel, hobbies, and spending time with family, supported by the steady income you planned for decades. Then, the morning mail arrives with a notice from the Social Security Administration. Due to the depletion of the trust fund reserves, your monthly benefit has been cut by 23%, effective immediately. For the average retired couple, that is a sudden loss of over $800 every single month. If that scenario makes your stomach drop, you aren't alone. But here is the reality. For anyone between the ages of 55 and 75, this isn't a hypothetical fear. It is a mathematical probability we must account for in our wealth management today. Recent projections from the Social Security trustees indicate that by the early 2030s, the system will only be able to pay out what it collects in payroll taxes. Without a major legislative overhaul, the guaranteed portion of your retirement income is facing a systemic liquidity management crisis. The context of this problem has shifted dramatically as we head into 2026. We are seeing a historic milestone where the full retirement age has officially risen to 67 for everyone born in 1960 or later. Simultaneously, new tax laws like the One Big Beautiful Bill Act have introduced a senior bonus deduction of $6,000, which provides a temporary cushion but doesn't solve the underlying funding gap. High-income earners are also feeling the squeeze as the Social Security wage base has jumped to $184,500. If you are a business owner or a professional with a high net worth, the risk isn't just a smaller check. It is the ripple effect that a reduction has on your entire portfolio allocation and tax optimization strategy. When one source of income shrinks, you are often forced to over-rely on your traditional 401k or IRA, which can trigger higher tax brackets and even increase your Medicare Part B premiums through IRMA surcharges. Today, we are going to look at the retirement planning strategies that actually work when Social Security benefits reduce. We are moving beyond the basic save more advice and into institutional-level capital allocation. We need to build a retirement engine that doesn't just survive a government shortfall, but thrives in spite of it. Step 1. The self-funded pension strategy. The first principle of institutional wealth management is diversification of income sources. If you treat Social Security as your only pension, you have a single point of failure. To hedge this risk, we look at creating a self-funded pension through a combination of dividend growth equities and structured income products. Consider the math. If you expect a $3,000 monthly Social Security benefit and it gets cut by 23%, you are looking at a $700 monthly deficit. To fill that gap using the 4% rule, you would need an additional $210,000 in your investment portfolio. However, a more efficient capital allocation strategy for a retiree might be to utilize a portion of your fixed income bucket to purchase a low-cost, institutional-grade annuity. By locking in a guaranteed floor of income that is independent of government funding, you reclaim your agency. For a 65-year-old couple, allocating a segment of their portfolio to a deferred income annuity can act as longevity insurance. This ensures that even if the government check shrinks, your essential expenses like housing and healthcare are always covered. This allows you to remain more aggressive with the rest of your portfolio, capturing the compounding power of the equity markets without the fear of a market downturn forcing you to sell at the bottom. Step 2. Tax diversification and the Roth hedge. The second principle is aggressive tax optimization. In a world where Social Security is reduced, your tax-free liquidity becomes your most valuable asset. If you are forced to take larger distributions from a traditional IRA to cover a Social Security shortfall, you are essentially paying the government a second time. This is why Roth IRA conversions are the ultimate hedge. Under the current tax landscape, we have a unique window. The senior bonus deduction of $6,000, or $12,000 for a married couple, can be used to offset the taxable income generated by a Roth conversion. Imagine you are in the 24% bracket. By converting $50,000 from your 401k to a Roth IRA today, you are prepaying the tax at a known rate. If Social Security is cut in the future and tax rates are simultaneously raised to fill the budget gap, your Roth withdrawals will be entirely tax-free and will not count toward the provisional income formula that determines if your Social Security is taxed. This is a double win. You protect your future cash flow and you lower the cost of your retirement by staying out of higher tax brackets. Step 3. Asset-based lending and liquidity buffers. The third principle involves sophisticated liquidity management. One of the biggest risks to a retiree's wealth is sequence of returns risk. The danger of being forced to withdraw money from a declining market. If your Social Security check is cut during a bear market, you might be forced to sell twice as many shares of your favorite ETF to maintain your lifestyle. Institutional investors avoid this by using asset-based lending. If you have a significant taxable brokerage account, you can establish a line of credit against those securities. In a year where Social Security is reduced or the market is down, you borrow from your own portfolio at a competitive interest rate rather than selling your assets. This keeps your capital working for you, allowing your dividend-paying stocks and growth engines to recover. You then pay back the line of credit during up years in the market. This strategy maintains your portfolio's integrity and prevents the permanent loss of capital. It is a proactive way to manage your balance sheet that treats your investments as a source of flexible credit rather than just a pile of cash. Step 4. The Medicare and IRA defense. Finally, we must address the hidden cost of retirement, Medicare. Many retirees don't realize that their Part B and Part D premiums are means-tested. If you have to pull extra money from your retirement accounts to make up for a Social Security cut, you might accidentally cross an IRA threshold. For 2026, if your modified adjusted gross income exceeds $218,000 as a married couple, your Part B premiums can jump significantly. We call this the Medicare cliff. To defend against this, you should prioritize non-reportable income sources. This includes health savings accounts for medical expenses, Roth IRA withdrawals, and even the cash value of a properly structured life insurance policy. By strategically sourcing your income from these non-magi buckets, you can keep your reported income low enough to avoid those massive Medicare surcharges, effectively giving yourself a raise by reducing your mandatory expenses. Action steps for a resilient retirement. If you want to ensure your plan is Social Security proof, here are the specific next steps you should take. First, run a benefit cut simulation. Go to your Social Security statement and manually reduce your projected benefit by 25%. Then, look at your current withdrawal rate from your 401k or brokerage accounts. Can your portfolio sustain that extra pressure for 20 years? If the answer is no, you need to increase your savings rate or adjust your asset allocation today. Second, maximize your senior bonus deduction. If you are over 65, make sure your tax planner is utilizing that extra $6,000 deduction to facilitate Roth conversions while tax rates are still relatively low. This is a limited time opportunity that sunsets after 2028. Third, explore guaranteed income alternatives. Look into institutional-grade annuities or high-yield dividend portfolios that can provide a reliable floor. The goal is to reach a point where Social Security is the icing on the cake, rather than the cake itself. Fourth, stay informed. The rules for required minimum distributions and Social Security funding are changing almost every year. We upload fresh videos on these high-stakes financial subjects regularly to ensure you have the latest data to protect your wealth. I want to hear from you in the comments. Are you factoring a potential benefit reduction into your current wealth management plan? Or are you operating under the assumption that Congress will fix the system in time? What is the one strategy you are using to lower your tax exposure in retirement? Your insights help this community build more robust financial futures. If you found this analysis of retirement planning strategies valuable, please click the thumbs up button to give us a like as a thank you for this content. It helps us reach more people who need this information. And be sure to subscribe to the channel so you don't miss our next deep dive into estate planning and capital allocation. I am not your financial advisor. The information provided in this video is for educational and illustrative purposes only. All investing involves risk, and retirement planning requires a personalized approach based on your specific tax situation and risk tolerance. Please seek professional advice from a fiduciary or a qualified tax professional before making any significant changes to your portfolio or claiming strategy. Your retirement should be the most rewarding chapter of your life, not a period of constant anxiety about government policy. By taking control of your tax optimization and liquidity management now, you are building a future that is independent of whatever happens in Washington. I will see you in the next video.